Okay. So the ones that are going to be bulldozed are more in the tier four. But, there's been a lot said about office to residential conversion. Okay. It's a much smaller portion of the tier fours than I think a lot of people think it is. I mean, you just have to think about the floor plate of a typical office building. Okay. I think most people who would live in an apartment would like some windows. And, if you think about a traditional office building, they are, if built in the 80s, 90s to now, it's usually about a 25,000 foot floor plate. Okay. How do you divide that into apartments and give everyone a window? I mean, really, the only way is having these extremely narrow hallways of apartments. Otherwise, you're going to have ones on the exterior that there's no way to lease. So it's really hard, if almost impossible, to convert some of these tier fours. However, there are a number of tier fours that were built in the 60s or 70s that have smaller floor plates, maybe, 13 to 15,000 feet. Those are pretty good candidates for residential conversion.
Welcome to CRE Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Joey Klein. Joey is the host of Tech Talk podcast, or the Tech Talk podcast. Joey is a seasoned commercial real estate broker focusing on representation of corporate tenants across a range of industries. Based in Atlanta, he's deeply involved in urban-focused developments and transit expansion advocacy, particularly in Georgia and the Southeast. And in just a minute, we're going to speak with Joey Klein about the commercial office space asset class and what it's facing. But first, a quick reminder, if you like our show, CRE Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Joey Klein. Welcome to CRE Radio.
Darren, I appreciate you having me. Looking forward to our conversation.
Likewise. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I guess first, I'm a commercial real estate broker down here in Atlanta. I'm an Atlanta native, although with experience living in other cities like St. Louis, DC, and London for different stints of time throughout my career. The thing that I'm really the most passionate about is the cities. I think that cities are sort of the, ever-changing portraits of America. When I go on vacation, I want to go to cities. I want to walk around, I want to get a sense of them. And one of the reasons I really dig what I do is because I feel like everyone, whether it's an architect, a developer, a broker, a business, has the ability to kind of paint a little bit of a brushstroke on a city. It's a constantly ever-changing landscape. And so doing what I do, that's my chance to be, a couple little brushstrokes on a city that I very much care about, every day.
Yeah, I love the thought there, the brushstrokes, and it is interesting, especially if you look over time. You ever look at those comparisons, over the years, kind of thing, how the picture changes. And especially, well, if you look at a longer amount of time, it's interesting. But anyway, let's talk a little bit about uh, commercial office space.
Yeah.
And I
Everyone's
guess,
favorite whipping boy.
well, I was going to say, what happened to commercial office space? Um, maybe the way to start is, uh, its purpose, historical purpose, use, and you know what happened to get where we are today, 2024.
Yeah. I think look, I find something interesting about all the real estate food groups. And I basically, in my mind, there are four major food groups, if you will: office, industrial, warehouse, retail, and multifamily, right? Uh, multifamily, multifamily has brokers in that they're investment sales brokers that help, you know, sell and buy large multifamily assets. But really, the traditional leasing broker, such as myself, is usually found in one of those three groups: retail, industrial, or office. And, you know, the really for the past couple of years, I think the winner of everything post 2020 was industrial real estate. And I'm happy to talk about that in a little bit why. Office space has always been somewhat interesting. I remember when I first became a tenant rep broker. In my mind, I'm hearing myself, talk to people at cocktail parties. But what do you do? It's like, I help people lease office space. And on the surface of it, it sounds a little dull, a little boring, right? We all remember the movie Office Space in the late 90s, and the, sort of, very palpable dullness and mundane nature of what it was like to be in that stereotypical office space. But, traditionally, before the age where we could do this over, the internet, there's really no other way to get work done, right? As people streamed into cities in the early 1900s, as more formal businesses arose outside of, more of an industrial, agricultural economy, you had office space, right? A place for people to come together. There was no ability to go home and just take it offline. And over the past 20 years, I think office space has really morphed into something more of I don't know, almost like a personality badge for a business, right? Whenever we talk with clients about what their office space is going to be like, very rarely, if ever, is it simply about having desks and people in a space, right? Especially now when people have the option of just staying home, it's just not good enough. And so, I think office space morphed in the latter part of the century as technology companies really started to compete for talent as a place that was almost more hospitality like than, concerned with efficiency. Not to say that it's not, but I think hospitality is really the biggest word that I would use to classify what office space has become, certainly over the past 4 years, but more so over the last quarter century.
Well, it's interesting. I like um, the thought as far as, what it implies and what it requires to attract and make it something or a place where employees want to, go to. I'm curious. Obviously, COVID was kind of the impetus for the mass change, but you mentioned something, tech industry, uh, and it didn't really occur to me, but I'm wondering, the way you presented it is that was kind of a leading edge industry that was challenged by this uh, remote work before the rest of us were. Is that
I would partially, yes. Look, I think that creative and technology industries were the ones that were certainly more amenable to a partial hybrid or remote situation, depending on the executive and depending on the role. Where I think their place comes in more is I don't know, you remember that MTV show, MTV Cribs, right? Where You go in and a, rapper or celebrity shows you their, 10-car garage with a Ferrari and, the place where they take their walks by some lagoon of their own. I feel like the technology companies are the ones that started the process of making office space almost like an arms race of who could have the nicest crib, so to speak. Because look, if the only way that you're able to keep an employee is by a paycheck, that is that's not a competitive advantage, right? That's a way to have high turnover. And so what I think happened in the past 20 years with technology companies, they became the companies that were growing the fast, commanded the highest salaries, compared to maybe lawyers or bankers, but in general. Um, and we're responsible for an outsized portion of white collar growth. And when you have all these companies springing up and they compete with the same talent, you have to have another way to keep people instead of just a paycheck. And we can come back to that because I think that's actually part of an issue with remote work. But you've got to have a place where people actually want to come 8 to 10 hours out of the day. If you're going to convince them to give you their mind and their creativity and their time, can't just be about money. Obviously, that helps. There's got to be something in the physical surrounding that support why they're getting out of bed every day and giving you their time and their intellect.
Yeah. Well, and just the current state of office, the office space, can you kind of give us a 30,000 foot view of what you see, what maybe is on the horizon compared to, where it was pre-COVID?
Mhm. Yeah. Okay, so I think multiple things can be true at the same time. Okay. It can be true that office, capital O, as a sector is not doing well. It can also be true that that is a unnuanced take and doesn't really tell the entire story. So what people read in, was recently there was a Wall Street Journal article just about extremely high vacancy rates. I actually think it might have been in Atlanta. It was, I don't know, 25 to 30%. And on at a macro level, that's absolutely true. If you go across, the biggest metros and even some of the secondary metros, right? Anywhere from Denver to Miami to Los Angeles to Dallas, right? If you take the if you simply take the traditional denominator and numerator, denominator being what is the percent of office is leased, excuse me, numerator being what percent of office is leased, denominator being what supply of office exists. Yes, extremely high vacancy rates. That doesn't tell the true story in that the office world, and this has been coming for a while. I mean, I think like most things, this was a trend that was already happening, and COVID simply just, struck a rocket pack to it. The office market has, I think, forever and inexorably bifurcated. There are haves and have-nots of the office market, very similar to, I think, a lot of, whether it's people, companies, cities in our society. There is a very distinct high and a very distinct low. So let's take just Atlanta because that's where I'm sitting. All right, Atlanta, and I mean Metro Atlanta, right? What they mean when they count the metropolitan statistical area of about a 6 million person metro, 10 to 15 counties, again, depending where you draw the lines. That's about 150 million square feet of office space. This is everything from, 3-story walk up to huge high-rise downtown. Okay. The issue that these articles don't take into account is that really the denominator has changed along with the numerator. The denominator is no longer 150 million square feet because we estimate this, and this is JLL research internally. These are what we call tier 4 buildings. And I can tell you what tier 3, 2, and 1 are. These are tier 4 buildings that are functionally obsolete. okay, that either because of layout, because of location, because of ownership, because of state, there's really nothing you can do to that building to lease it up. Slowly over time, tenants are going to forego renewing and move because it is not an inspiring place to work or to force, quote unquote, your people to come in. Um, and I don't mean this figuratively, I mean it literally. I don't think a landlord could literally pay a tenant to come occupy these spaces. They can barely get tours, and this is what I see as a tenant rep broker. Traditionally we would have, maybe one or two kind of budget discount options on the list that we would go out and tour. And sometimes that would be the justification for making a decision of where to occupy. Never. It never is now. And so the reason why the denominator has changed and why down here it's not 150 million feet anymore is because I think, and this is, again, it's my opinion, but it's also backed up by some JLL research. I think 25% of the building stock might as well be invisible. It might as well just not exist. And so when you take that yes, has demand decreased from a high of 2019? Yes. Has it come back sharply from where it was in 21 and 22? Yes. Even if the number is lower than it was in 2019, the number on top, the number on bottom is lower too. There are only certain types of buildings that are actively seeing new deals right now. And so that's why the conversation about the office market is really a flawed one, because there are certain buildings where it's like, what pandemic? What remote work? Because even if a company is cutting their space from 50,000 to 30,000 square feet, they are going to the brand new fanciest building. Those buildings are not having any issues. Oh, I said a lot there. I'll stop and let you react.
No, I think the way you divided it, and I'd love to hear more about the different tiers, but the kind of the obsolete, worn out, no longer viable. I'm curious, do you find that tends to be a particular um, age? Is it a particular location, or is it a particular style that you find that fits that
Yeah,
more often than not?
that's a good question, because I think that most people hearing that tier 4 would assume that these are just, kind of the same old 4 to 6 stories suburban office building surrounded by parking, up and down, every kind of cookie cutter suburb in America. That's not to say that's not included, but this classification is across all different types of geography, urban and suburban. This classification absolutely applies to buildings in the middle of the city, just as it does in the outer reaches of the exurbs. So again, we're using Atlanta as an example, right? You know, there are buildings that are tier 4s in the heart of our downtown. There are buildings that are tier 4s in, some of our most affluent suburbs like Sandy Springs and Alpharetta. The flip side is also true, right? There are tier 1s and 2s in Midtown and downtown, just as there are tier 1s and 2s in our best suburbs.
And just real quick, to be clear, the tier scoring thing, is that just in like, what does that represent? Is that
Yeah, so look, part of this is
amenities or?
JLL nomenclature, but I think it's illustrative because it's, it's still a numerical ranking system. Age of the building is also a factor. So we in our research, we show that the only category of building that has positively absorbed demand are properties that were built or renovated after 2015. That doesn't mean that there are not deals going to buildings that were built or renovated before 2015. It means that that sector as a whole before 2015 is what contains most of the problem product that brings that number down into negative territory. But to give a quick descriptor of the tiers, just so everyone's on the same page with what I mean, tier 1 is, trophy office building. This could be a high rise. This could be an adaptive reuse project of a warehouse that was built or renovated after 2015. and is highly amenitized, you know, for lack of a better term, the type of place where you would see Google put their employees. Tier two is, solid product built maybe in 2000 or the early part of the 2010s, kind of an A minus, A plus type of project. Tier three are older buildings that are well located and with some lipstick and renovation and some, increase in their amenities and aesthetics can really be competitors. And then tier four are the properties that either based upon age, location, style, or some factor of all those put together are just simply not coming back.
Yeah. So are you I guess the lower tiers, obviously the trophy and the solid tier one and two seem like they're in pretty good shape. Um, is there any amount of renovation, or is it pretty much a lot of these need to be scrapped, these tier four product?
There's no amount of renovation. I mean, tier four is essentially, you know, basically going to the owner and saying, we're sorry, your beloved pet has rabies. We need to take it out back and just put it out of its misery. But not so not only that, here's the thing. Let's, for argument's sake, hypothetical, say that there was some degree of renovation that you could increase occupancy by, I don't know, 30 to 40%. Okay. You couldn't get it financed. That's also the problem, right?
Yeah.
If you could have the best of intentions, you could have an ownership group with an incredible track record of turning crap into gold. Okay. Go to one of these properties and say, we can do what we did for XYZ building where Google took the whole thing. We can do that for this tired 4-story suburban office building. Even if they had that vision, and I think that vision is flawed, okay, but even if they had a compelling argument, no way it's getting financed. No way that you can convince you can barely convince a bank right now to renovate incredible office space, right? There's no way that you're going to convince a bank right now that you're going to get the leasing velocity and return required to actually make money on that property. So even if there are the best of intentions, logistically, the deal's just not happening.
Yeah. So, I mean, that brings up a huge, um, you know, factor in all of real estate is the financing. Um, so I'm curious, are the banks aware of this, or are the banks becoming aware of it?
Very, very. Um, there is an outsized percent of the commercial real estate debt on the books that is coming due within the next couple of years, talking about billions of dollars. Um, and oh, look, I've seen different takes, right? Some people think this is a ticking time bomb, um, because at the end of the day, the banks don't want these buildings back. What are they going to do with them? They can't lease them, right? They're just going to hire someone else to try and lease them. They're going to end up likely selling them at a loss or maybe just break even. But the status quo, if you have tenants leave and you can't lease the building up, it's a vicious cycle, right? The more that you have tenants leave, the more your cash flow decreases. You have an outsized portion of your cash flow going to service the debt, which means you don't have enough money to attract new deals, but you can't get the bank to give you more money. So it's just, I mean, it's a recipe for implosion. The banks are
Yeah.
very aware of this. Most of them do not want these buildings back. They have been, for the most part, engaging in what we like to very colloquially call extend and pretend recently, which is, as it's exactly what it is, right? You are giving the landlord an extension on their loan, hoping that, maybe against false hope, that things turn around and in a couple of years that, they can truly, refi and be able to withstand a higher interest rate. Um, so look, with most things in life, I think that the truth is somewhere in the middle. Do I think there's going to be an '08 style implosion because of commercial real estate asset level debt? No. Do I think that there are going to be a lot of buildings that are in dire straits and either someone buys them for pennies on the dollar and or they just kind of languish there because no one's doing anything with it? Um, and that requires, a large write-off from the banks. Yeah, I think both those things can be true at the same time.
Yeah. No, it's the timeline is pending as far as all of this, and excuse me, the um the picture doesn't look good, but I appreciate you providing some clarity because it's not all bad. At least what I'm kind of understanding, and our conversation here is that it's more of these buildings that have outlived their usefulness, and are no longer appealing, that are really going to struggle. And so I'm curious, we talked, or you mentioned, valuations and occupancy rates, how they kind of dictate that. Are you finding that the buildings that are in the tier 1, 2, and 3, are they pretty much holding their value? And is it strictly limited to the tier 4 buildings that are really the the source of the
Yeah.
issue?
It's not limited to tier 4, right? There are, as we said before, right, it can be true that there are positive signs, but there are really issues in the office sector in general. Um, like I think that we've gotten to a point where to most executive committees, it's very clear the office is not dead. The office is not going away. Okay. The office evolves just as it did for the past decade or so. And honestly, and I have to separate the way that I actually make a living from this. I always thought that the need or the mandate to have a worker at their desk 5 days a week, some number of hours a day, was a bit of an unnecessary one, right? I'm not saying that it's, for certain roles and certain groups, but um, I think that if you have an employee or a team that you feel that you cannot trust to get their work done if they are not in your line of sight, you have issues as a manager and or you have issues with your team. Okay. So look, most people are now using the office the way that brokers like me have for years. We use the office as we need to. Now, we sort of get that privilege because we don't get paid a salary, right? It's, kind of tough to tell us to come sit at a desk when everything is kind of incumbent upon our own effort. So commission salespeople have always been in somewhat of a unique position on that front, but it's one that I think, aside for some emotional instability, sometimes is related to our income, it really benefits our lives in terms of our flexibility with our own time and frankly, with time with our families. So I am glad that much more, a higher percentage of workers now actually get that flexibility because I think that's a really good thing. I think that's a good thing for human flourishing, um, and just for, overall mental health. But I, the pendulum has swung from, I cannot tell you how many times I'd run into, clients of mine or simply just, friends who are in some sort of middle management position that have really changed their tune on how much remote work there's actually going to be. Um, Go back to what I said earlier. If there is no connection between you and your company and you and your coworkers outside of the money that shows up in your bank account every couple of weeks, that is not a motivated, efficient, or loyal worker. Um, and so we are seeing the workplace reimagined. We are not seeing the workplace go away. So yes, it can be true that demand is down. And I mean, look, all the big commercial real estate firms. Now, this is also because capital markets transactions have been down, right? That earnings across the big brokerage firms have been down. But when I look out on my colleagues at my firm, but also at our competitors, CB, Cushman, Newmark, whatever it might be, um, is there pain? Yes. Are we all, I think, generally in a feeling pretty positive about where things are headed in the next couple of years? Yeah, I do.
Well, the optimism is encouraging. Because
I
I
don't know
think,
what other way there is to be. If you,
well, no, I agree. I
yeah,
mean, there's I think one of the things I've kind of come to realize here in recent, recent years is that part of the beauty of the American economy is there's always an element of chaos, and that in that chaos creates the opportunity. And
absolutely.
it's as a consumer, it's not necessarily welcome or wanted, but for capitalism, it's truly kind of one of the secret little nuggets to make it really work and attract new capital. There's always winners and losers, but
Yes.
there's always an opportunity in whatever the market cycle is, wherever we are in the market. So, as you've kind of detailed, there's going to be a lot of losers based on, what the asset is, where it is, um, how tired or desirable it is not compared to what it once was. But for all of those losers, there'll be somebody that's able to, pick one up for a discount
Yeah.
and convert it into a real winner. And it's always you hope you're on the winning side of that conversation more often than not, but it is kind of the you know if you step back and look at the market, that's really kind of that you know I don't know how to summarize that, but it is something that I see that to recognize.
I think that's a
Excuse me.
really good point, right? The opportunity that comes out of chaotic and sometimes negative moments. I mean, look at what came out of '08, right? In terms of, well, a lot of things, but I mean, the run-up growth and revitalization of a lot of our urban centers, certainly in the Sun Belt, I think it was already underway in a lot of other gateway cities, but really happened in kind of the decade, after the Great Recession. I mean, certainly here in Atlanta. When I moved back to Atlanta for business school in 2011, I lived in Midtown. Okay, I had come from DC. I wanted to replicate some of the street grid and walkability of that city. There was still, I mean, just every couple of blocks, empty parking lot, empty parking lot. And when you look at the skyline now of Midtown, at least, there is barely any developable land left. It is many parking lots have met their maker, as I like to say. And that happened across a lot of cities, certainly in the Sun Belt, Nashville, Charlotte, Austin. I realize that I failed to fully answer one of your questions recently about, are the valuation issues hitting tier one, tier two, and tier threes? And the short answer is yes. I mean, I can think of one building here in Atlanta that is a very much a tier one, brand new build that has attracted no tenants, and it is being sold, and it will be sold for less than it costs to build, if it sells at all, right? Now,
Yeah.
there are other issues with that one. There are absolutely other tier ones that are in a totally different situation, but it is just being a tier two or tier one is not a magic bullet to dodge all of this.
Yeah. No, I guess the spectrum is full of, uh, different levels of opportunity in each one of the tiers and the classes. Um, I'm curious from where you sit and what you see, uh, who who are the owners of these properties? Are they REITs primarily, or are the ones that are more in the line of fire more individuals? Um, what do you see, and from a standpoint of just ownership levels of those that are going to be most affected?
Sure. So I do not deal with many mob and pop owners, is sort of my, colloquial for, a guy, right? A guy who's not a professional real estate investor. Maybe it was something, a building that's been in the family, for a couple generations. Um, We primarily do not deal with those sort of properties. Now, that is also just kind of the nature of the large company that we are and the nature of our clients, that they're not occupying those. So, that is not to say that I would say that let's call it 5 to 10,000 square foot office condo, that someone owns that is leased out by a, 3-person, CPA, right? That's not really a lot of what we're talking about here. The buildings that we're talking about, and certainly that are included in that 150 million square feet across the metro, we're talking about institutionally owned office properties. And that could be anywhere from a REIT to a family office to, kind of a regional, investment firm. It really runs the gamut. I will say that the ownership groups of the ones and twos certainly skew more towards the large REITs. That's not to say that there are not, individuals with, a well-heeled family office behind them, or more of a kind of regional private entity that owns these. If we're talking about, deep into the burbs, right? The sort of faceless, nameless, 150,000-foot buildings surrounded by parking. Those are not usually the biggest REITs in the market. Though that ownership is typically concentrated in the urban core and the very the well-heeled, sort of suburban nodes that have become real attractors of Fortune 500 and 1,000 companies. So I would expect to see more of this sort of a pain on the smaller, still institutional, but smaller real estate shops.
Got it. And as far as the properties go, we've talked about how they're kind of, especially this tier 4 product. But even up and down, some of these, like you mentioned, like, class 1 where it's empty and going to be sold or for sale. Um, is the recovery, is the option more often just to doze it, start over, or is there a potential to reposition any of this?
If
Or
we're
do you have
talking
any thoughts on?
about if we're talking about a tier 1 or a tier 2, usually that is not that's not a knockdown, right? Because there's something good about the underlying area or tenancy of those buildings, right? Again, the one that I gave you, it is in really the highest performing submarket in Atlanta, right? And it was built a couple years ago. There's no reason for that thing to be knocked down. When you no, frankly, nor would it be sold for a number that would make sense to knock it down and then build something new. Okay. So the ones that are going to be bulldozed are more in the tier 4. But, there's been a lot said about office to residential conversion. Okay. It's a much smaller portion of the tier 4s than I think a lot of people think it is. I mean, you just have to think about the floor plate of a typical office building. Okay. I think most people who would live in an apartment would like some windows. And, if you think about a traditional office building, they are, if built in the 80s, 90s to now, it's usually about a 25,000-foot floor plate. Okay. How do you divide that into apartments and give everyone a window? I mean, really, the only way is having these extremely narrow hallways of apartments. Otherwise, you're going to have ones on the exterior that there's no way to lease. So it's really hard, if almost impossible, to convert some of these tier 4s. However, there are a number of tier 4s that were built in the 60s or 70s that have smaller floor plates, maybe, 13 to 15,000 feet. Those are pretty good candidates for residential conversion. So I would expect to see a small portion of those tier 4s reimagined as multifamily, the ones that are well located and have the floor plates that allow for it. But the the 25,000 foot floor plate, in a, suburb off exit, whatever, that's really hard. I don't know what you do with that other than let it sit until the land is worth enough or worth not enough that you can buy it and justify building something on it.
Yeah. No, it's a conversation I've heard, a lot of interest in the conversion of properties, but kind of along the lines of what you were talking about is just the nature of the product and the feasibility is not always, something that makes sense to do so. Um, on on the financing thing, so we talked about these tier fours that are not financeable. Beyond that, um, you know, buildings that are mostly full, not considered a challenge as far as occupancy goes. Are you seeing that uh, financing is available for the owners and or potential buyers?
It's available. It has never been harder, though,
Yeah.
really. I mean, I really feel for look, I am very fortunate in that I represent tenants. Okay. And in this market, tenants are the ones who are making the decisions and really running things. Um, I've frankly never had as much power to help a client in my entire career. And so it's a very interesting time to be a tenant. It is, I think, better on this side of the equation. I really feel for landlord brokers, for landlords themselves, for bankers, for our capital markets brokers that are involved in the, sale and purchase of these buildings or the placement of debt or equity. It is really tough out there. Yes, the best buildings that, have good tenancy are getting financing, but ownership groups are under a microscope like they never have before, and it's just a much, much more complicated process than in the past. And I understand the necessity of it, right? I mean, you're taking a large amount of capital from a, generally risk-averse institution. I get it. It's just being an asset manager right now in the office real estate sector is one that I think could use some, therapy or,
Right.
heavy drinking, whichever one you
Yeah.
prefer.
Yeah, no, I can only imagine the pressures in that situation. You mentioned as a tenant rep, you're more in control. Are there can you describe some of the opportunities or what you've been able to get that perhaps before were not even on the table?
Yeah. And I will say, look, a lot of this is, look, the Sun Belt in general has really been outpacing the rest of the nation. This country grew by 1.6 million people last year. 1.4 million of those came to the South. Right? The South is absolutely having a moment. And so I recognize that, part of my good fortune is based on the location that I'm in, right? That's not just that. Look, there are plenty of deals to be had in other markets as well, where activity is even less robust than here. Um, some examples. So we haven't really seen face rental rate numbers change that much, at least in our market. Okay. Because there's still enough demand, and because at the end of the day, for an institutional investor, the most important thing for the valuation of that building and what it will be worth upon sale has to do with the headline rent rate. But landlords are getting extremely creative in the arena of additional concessions to basically bring down the net effective rent rate. So, you might have a market rent, but, we're seeing really crazy free rent packages. You know, traditionally free rent came to, maybe, 3/4 of a month or a month per year of term. That has increased greatly. I mean, for a credit tenant, I mean, certainly 1.5 months of abatement for a decent enough space per year of term is really not out of the realm of possibility. Same thing goes for capital. Um, Landlords have had to give more capital, what we call tenant improvement dollars. This is basically money for the tenant to help build out their space. Uh, Additional capital is not only required just because construction costs are up, but also for just added concessions. I mean, the amount of money that we're seeing landlords give to tenants is more than ever before. Um, Ability for a tenant to sort of staged in a staged manner take a space. So let's say that you have the usual path for a technology startup used to be, you have two guys in a basement, then you're in an incubator, then maybe you jump from sublease to sublease, and then you take, what I like to call like a big boy space, okay? Because flexibility over all else is important to them. Well, what I've done with a couple of clients is they don't want to do all that jumping. It's a pain in the ass, okay? But they also don't really know what their head count's going to be, but they definitely know that they don't need, let's call it 20,000 feet on day one. And so you go to the landlord and you say, we know this is the space we want to be in, okay? We know this is where we want to put our people, and we can commit to you for, let's call it 5 to 7 years. But we only want to pay on 5,000 feet for year one, because that's only what we'll be using. And we only want to pay on 7,000 feet for year two. And you kind of, gradually go up. Look, essentially, it's just an above market free rent package because you have access to the entire space. So those sort of creative things are what I and my colleagues have been able to do to really help our clients take advantage of this very unique moment in time.
Well, and for the landlord to know that they've got, someone in the space, and
Bingo.
you've got the built-in increases. That's all part of it. So to know there's something, on the horizon as opposed to an empty space and nothing coming in. I mean, at least you can probably help cover some of your expenses and/or at least meet your zero out as opposed to go negative kind of thing. So,
Absolutely. But look, I'll tell you on the flip side, I'll tell you a horror story as well. I mean, and I think this is very representative of where the market is. I had a client in an out. So I mean, look, I'm based here in Atlanta. I would say probably the majority of my work is here, but certainly more so recently in the past couple of years, I have clients where I'm doing work for them in different markets across the country. Which of course is partly why I work at a big company, because I can easily call up JLL Raleigh and know that I've got a colleague there who's qualified and can help me. I was doing work with a client in a market in the upper Midwest, and we were taking over a space that had recently, the tenant had gone bankrupt. It was a pretty decent sized space. And we had gotten the landlord to agree via their equity partner to a pretty hefty tenant improvement allowance. And basically at the 11th hour, the equity partner basically came in and said, I'm not comfortable putting this much money in after, agreeing to it, right? And it killed the entire deal, right? Because the landlord at that late date doesn't really have the ability to go to the bank and start a whole process and still be on our timeline. From our side, it's like, well, look, one, that's really crappy that you went back on your word. But two, if this is what dealing with the organization is going to be like, well, this is a red flag. So the never before have tenant rep brokers really had to be as informed and educated about what's going on with the capital stack of their buildings. It is, look, obviously that was not a great situation. That was very upsetting, but it has, look, as a guy who went to business school and has, an interest in, other areas of finance, but just beyond what I do on a daily basis, I will say that it has been very intellectually stimulating and interesting to peel back the hood and see that part of the real estate world that I think a lot of brokers in my position didn't interact with as much as they should.
yeah, I mean, another data point to definitely be aware of, as opposed to just we love the space, love the space, love the space, and whatever your rent
Totally.
is, but to know how, it's funny because I think historically it's always been about the landlord, uh, checking the credit of the tenant, to make sure that they're going to be are able to continue to pay their rent and be around for a while. Um, but that's the first time I've heard nor even thought about the need to check the credit worthiness of your landlord. Um,
It's imperative. I mean, it
yeah.
really is. It's just necessary to get a deal done. It's also necessary to protect your client. Um, it is not enough to love the space. It used to be enough. It's just not. The world gets narrowed very quickly to landlords that can actually transact. We call it transactability, right? We score this internally. It's something we now have to think about.
Oh, that's great. Hey, Joey, if we could, I'd like to shift gears here for a second. As I
Sure.
mentioned to you earlier, by day I'm an insurance broker, and as such, I like to, or when I work with my clients, excuse me, when I work with my clients, we assess the risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. That's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, landlords, um, the market, interest rates, whatever you identify and consider to be the biggest risk.
Mhm.
And again, for clarification, while I'm an insurance broker, I am not necessarily looking for an insurance related answer. And so, if you're willing, I'd like to ask you, Joey Klein, what is the biggest risk?
Sure. I don't have an insurance related answer, so that's good. Um, I have to say I do think that your industry is a very fascinating one, and I think if we had more time, I'd love to throw some of these back at you because insurance is a very rapidly changing industry over the past couple of years as well. Um, I look, I think that anyone who makes their money solely via commission has to constantly be thinking about risk. And if you're not, you probably won't be doing it for very long. So it is something that I think about a lot, sometimes too much. Um, and Atlanta is well, and I think commercial real estate in general, right? Unless you're in a really small tertiary market, Valdosta, Georgia, right? You kind of have to be a jack of all trades. Okay. There's not enough of one food group to really, feed you. In a market like Atlanta, you really have to specialize. Okay. What I've tried to do is within my specialization, diversify. That's how I think about risk. So my specialization is that I only represent tenants. I do absolutely no work whatsoever on behalf of landlords marketing buildings. That's not to say I don't think there's anything wrong with that. There are absolutely guys I know who do both sides of it, and they do well with it. I have very simply chosen for that to be my line in the sand. I only do work with tenants. However, within that work with tenants, certainly since 2020, I have tried to diversify the areas in which I do work and in which I target prospect, potential clients. So I was very, very heavy into, sort of growth stage, early stage technology companies at the start of my career. And part of that was because I enjoy spending time with those people. And part of it was because as a younger guy starting out, it's a little bit easier to get a meeting with the, CEO who's your age at a 10-person company than the managing partner at a law firm. Okay. Um, and when 2020 came, those were some of the really hardest hit companies. Not only because venture funding dried up, not immediately, of course, with them, but also they were some of the ones that took the most to remote work. So ever since then, I have diversified who I work with, right? More of a focus on professional services and finance, right? Those are some of the biggest uses of office space recently. A a good portion of business focused on not pure industrial manufacturing, but more of flex. Flex is basically the office in the back, the warehouse in the front. All right. So, I helped a large water meter company establish kind of an HQ2, where they had a big office there, a warehouse, and manufacturing. Not only was that diversifying the type of group that I worked with, it was also extremely interesting. I do some sort of pseudo hospitality work. I have a social club that I'm working with right now who wants to set up a location in Atlanta. Likely it will be in an office building, but it's a different use. So my risk assessment has been that while I am not trying to be a jack of all trades in terms of just any industry out there, that it's really important, especially right now, to to increase the types of people and industries that you have in your orbit.
Yeah, that's a risk manager answer right there. I see it all the time from insurance. It's like it's interesting how the want to specialize and focus, and but when that industry is going through a tough time, it does make your life a little more challenging if that's all you're in. So I get it. I get it loud and clear.
Well, in our unpredictable income with two small children, I think that'll make anyone a pretty good risk manager.
Yeah, well, that's good. Hey, Joey, where can the listeners go if they'd like to learn more or connect with you?
Yeah. You can check me out on LinkedIn, Joey Klein, Kline. You can also look up the Tech Talk podcast and check out my archives. You can look up my personal website where I feature a lot of the work that I've done, which is simply joeykline.com. Again, JOEYKLINE.com. I really enjoyed this conversation, Darren. I thank you for having me on. These were great questions.
No, I appreciate it. Well, Joey, thanks for taking the time to talk. I have really enjoyed it, learned a lot, and look forward to doing it again soon.
Likewise. Thanks a bunch.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.